When you're thinking about what an exit looks like, there's pretty much the way we see it's either an asset sale or a stock sale where the entire company gets acquired. Stock sales are going to be more favorable for a seller. No doubt about it. There's more tax benefits. The company doesn't pay tax. It goes through to the investors when a stock sale is occurring. An asset sale, a lot of times the buyer may prefer because you're buying the specific assets of the company. So you're not necessarily assuming all the liabilities that would come with buying the actual stock of the entire company. If you buy the entire stock of a company, you're also buying all of the assumed risk and liabilities that come with that company. So I would definitely say our advice is pretty much not to do an asset sale unless there's specific reasons or you're selling off a piece of the business. If we're talking about a full-blown exit.
You're listening to Ecom Finance Experts by Finaloop, where we dive into e-commerce finance best practices with the sharpest minds in the game. I'm joined today by Sam Greenbaum and by Dana Evanik, both from Withum. Sam is a tax partner. Dana's a tax manager, working in the ecom and corporate space. Thank you guys for joining us today.
Yeah, thanks for having us.
So we're going to dive right in. A lot of times founders don't necessarily plan ahead and they kind of just like start with their product, with their business and don't necessarily think about tax structure. So if someone approached you and they did plan ahead, or if they didn't and they're kind of trying to figure out things now, why would you even say a tax structure is so important for deciding how to manage your business?
When starting a business, I think one of the most important decisions a founder is going to make is that legal structure for the company. And it affects how you're taxed. It affects how you can raise money and capital and how investors view your business. So the structure you decide on today might not really be the structure that you need in 2 to 5 years from now. But me and Sam could walk through today on like the items you could consider when setting up your business, or maybe like as your company matures, how you're thinking about switching to a different structure. For example, if you are a founder who plans to start and grow your business without external funding, maybe an LLC is sufficient to start out because it's simple, it's flexible. But if you're planning to raise venture capital, maybe attract angel investors, that strong structure could be, or the wrong structure could actually be a deal breaker in the long run. So making the wrong move early on could really slow down your growth later on. We always advise to consult with your legal team and tax advisors at the same time to ensure that your goals now, or your structure now, aligns with your long-term goals for the future.
Okay, that makes sense. What percentage would you say of clients that approach you are ones who plan in advance before setting out versus ones who kind of made some kind of rash decision and then are trying to fix things retroactively?
I actually think most of the clients that come to us for the most part have those. So I always say, like, look, we're tax people. And, you know, I understand that a small company, maybe they don't like tax just isn't that important. I'm like, just use good legal counsel. Get good outside advisors that understand the startup world and understand what your intentions are, because that to me is the most critical in all honesty. So I would actually say that most of the clients that come to us do heed that advice and end up in a good position set up. We see mostly C Corps in full transparency. We also see some flow throughs, LLCs typically in our space, but definitely the C Corp structure is what we see the most often because they're looking to raise venture capital. So if I was going to put a percentage on it, I would argue probably at least 90% are set up in a way that's beneficial. But I also just want to caveat that even if you set up as an LLC but realize that you want to be a C Corp because you want to raise venture capital, you can change that. You don't have to be an LLC forever. You're not doomed. There's ways to go in and modify the structure to take advantage of what makes sense for you long term.
Right. Okay, that's helpful. So now kind of like walking back and like we were discussing C Corps, LLCs, etc. What, if you can maybe like summarize and put out in just like a couple of words, what are the main entity types that people do consider? Maybe if you can give our listeners a little more color on that.
Yeah, so the most common that we see are the C Corps, but there's also LLCs, there's S Corps, and each have their unique pros and cons, depending on what your business goals. Like Sam said, in the emerging growth space, we often see the C Corps like the most popular among our clients, but maybe for those smaller businesses, more bootstrap, the LLCs probably are a little more popular for those because you can set them up quickly. They offer limited protection should the company have any issues. And then LLCs are unique in a way that you can actually choose how you want to be taxed. So you could choose if you want to be taxed as a partnership, an S Corp, or a C Corp. So if you decide to be taxed as a partnership or S Corp, those profits and losses actually flow from the business to the individual members' tax returns, meaning they benefit from that income or loss, and that's called pass-through taxation. So C Corps are a little different in that it'll just be a flat corporate tax, and that doesn't flow through to the members.
Right. And what would you say would be the point? I mean, C Corps obviously have a lot of advantages, but they're also more expensive to maintain and to manage. What would you say is the tipping point when brands decide I'm becoming a C Corp? Meaning, would you say it's usually from onset, people just want to have that two-tier taxation and the structure? Or is it a kind of like most of them start as an LLC and once they hit a certain revenue point, they make that switch?
I would say most of our companies come in as C Corps for us specifically, but we do often see conversion from an LLC to a C Corp. Maybe if they're looking to raise funds, because for C Corps, there's no restrictions on the number of shareholders. You can issue multiple classes of stock, and there's like a clear equity structure with the cap table. Versus an LLC and an S Corp, there's more restrictions. So S Corps, for example, you can only have one class of stock, and you can only have 100 shareholders. So you're a little more limited there, especially if you're looking to scale rapidly or maybe raise outside capital. In that case, a C Corp would be best. But for the most part, our companies start off as Delaware C Corps.
I think a lot of the times, just to chime in, our founders sort of, I think from the get-go, have an idea of where they see what their 5-year plan looks like or what their future looks like. And as a result of where they kind of envision their company going, that sort of drives, I think, the initial setup. So, I mean, I think sometimes smaller companies that maybe don't know where, if they're going to, what their go-to-market is, might start off on that smaller LLC structure that's more simple to set up, like Dana mentioned. But then, if they start to grow and they want to, they really want to raise capital, we see these days the landscape is that venture capital really wants a C Corp structure. We can get into it later, but the reason also is that there's a tax code section called section 1202 qualified small business stock, which has significant tax benefits when you are selling your shares of a C Corp. So it's just a more attractive way of getting capital it's through that C Corp, which we can obviously go into at some point during the podcast.
And do you have clients who are moving over or starting as S Corps for like the reasonable compensation and saving in that respect, or you see less of those?
I see less you said S Corps, right? So
Yeah.
I see less S Corps, probably because when I mentioned the qualified small business stock, an S Corp is there are a lot more challenges from converting to an S Corp to a C Corp and maintaining that qualified small business stock status. So I would say that S Corp is the least common structure that we end up seeing, since I don't know that truly. I think it's the most limiting in terms of its ability to restructure. And I don't know that the benefits that it offer really outweigh, I think, some of the other challenges. Or right, if your cats, like the said, your cap table can't go over 100, and like you've been really foreign investors. So I think it's a little bit more limiting. And so I don't think that the pros outweigh the cons personally, from what I see, from an S Corp perspective. But for some companies, that makes sense for them. So I don't want to speak for all companies.
Right. Interesting. Right. Because I would think if you're a smaller brand who doesn't necessarily have aspirations for raising capital, it might make more sense once you hit a certain turning point with self-employment and etc. But
Yeah, I mean, for sure, there's definitely some. I even think just the being able to pay yourself a salary makes things more straightforward. I just would want to caution anyone that's setting up as an S Corp of them understanding what the limitations are and what the long-term pitfalls could be, so they understand from the get-go. And this is why having good legal counsel, I always say, is the most important, because the last thing you want to do is set up in a way that ends up being unfavorable
Yeah.
if the plan changes. So, but I agree, if their long-term plans are to stay a smaller enterprise, then yeah, an S corp setup is certainly reasonable and a good approach.
Reasonable for reasonable compensation. Um, and where most, you kind of mentioned before that you've been seeing a lot of like Delaware C corps. You say that's the most common structure. Delaware as well.
Yeah,
Yes.
yeah. So to say Delaware is definitely by far the most common state we see for incorporation.
Right. Okay. And you kind of mentioned 1202 and QSBS before. You want to run through kind of how that works and kind of give our listeners a little bit of an explanation about that.
Yeah, I'm happy to do that. So Section 1202 qualified small business stock, if you haven't heard of it, it's probably gained more popularity in the past couple of years just because it's a newer code section. And there were certain requirements that had to be met. So I think it was only about like 6 or 7 years ago that you started seeing people take advantage of it, which 6 or 7 years is actually a really short time in like the life cycle of tax code sections. So qualified small business stock essentially will allow shareholders to have a gain exclusion of up to $10 million on the sale of their shares. So essentially what that means is if you sell your company and you profit, you have a gain of $10 million, you can pay $0 of tax on that at the federal level. Some states conform, some states don't. We probably don't need to go into that today, but there are requirements that have to be met in order to qualify as a qualified small business. So the most popular one to probably hear is that when you receive your shares, you have to have less than 50 million of assets. You have to hold your shares for 5 years. These have to be originally issued shares and from a C corp. So the C corp is really the biggest thing. There's other requirements that make this more complex, which is why we always recommend, if you are going to sell your shares and treat them as QSBS shares, that you get some sort of formal memo or opinion that confirms that, since it's a significant tax savings. But that is really, I think, a huge attractor, since that's a significant tax savings to not pay tax on $10 million.
And I would say like most of our e-commerce companies would qualify, but if you are not a service, it's because they're not a service-based business. But if you think of like accounting firms, law firms, professional services, then they wouldn't really qualify under the QSBS.
Right. There are certain industries that are qualified industries that allow the qualified small business stock treatment, and there's some that are excluded from that. But yes, e-commerce and businesses in general and consumer products would fall under the category of being includable in the under 1202.
Right. And you don't need to make like an election or anything affirmative at the onset, right?
It's actually, I'm glad you asked that. It's such a misconception. I have so many people that reach out to me early on. They're like, can you give me something that says I'm a qualified small business? And I'm like, there is nothing that exists. There's no checkbox. There's no elections. It's simply just something that you have to test for. But the biggest thing too is that there's a 5-year holding period, and a lot of the tests that have to be met to make sure you're a qualified small business have to be tested for substantially all of your holding period. So I could tell you that on day one, based on how you're set up right now, sure, your stock will be QSBS, but I won't as of day one, but we won't know until we test the entire holding period and when the sale occurs. So yeah, there really is nothing you can actually do on that day, but there are certain but if it's not a new company and you're about to invest in a company, there are things we can mention so you can ask to make sure that you're investing in a company perhaps that is that you'd be getting QSBS shares. But there's nothing, like you said, there's something formal that has to be done on the first day.
Right.
Now, I just want to throw this out there. If anyone receives restricted stock awards, make an 83B election. If you take anything away from this, you have RSAs, you hear the word 83B, do it, because that starts your holding period for 1202. And there's a lot of tax disadvantages to doing that. So take that away from today, at least.
Okay, that's a good takeaway. And now to kind of just circling back to the 1202. So I believe it's either 10 million or 10x your basis, correct?
Yes, it's 10x basis also, but people tend to get a little confused with that. So I usually just lead with the 10 million, but correct. So typically, if you're a founder and you're starting a business, your basis and the shares that you're receiving is pretty much zero typically. So 10 million ends up being the more common threshold, But if you are again an investor or investing in a company and you're paying a real dollar value for your shares, 10 times your basis could certainly be more than $10 million.
Right. In theory, it could be anything, I guess, less than 50 million times 10.
Yeah.
I'm just curious, do you see that the average brand that comes to you has this like in mind when they're thinking of C Corp, or it's something that like you need to kind of explain and set out for clients?
I would say kind of half and half. We always bring it up on like our planning or proposal calls, asking if they've heard of QSBS before. I'd say half the time they have, half the time they haven't, but we always want to make sure we get in front of them as soon as possible so that they're thinking about that and planning for it.
And just one kind of maybe drill down question. If you're an LLC that elects to be taxed as a C Corp, does that count for QSBS, or do you need to actually be a real full-blown C Corp?
That's fine. You can, as if you're being taxed as a C Corp, you can have that QSBS status.
Got it. Okay. And the 5 years start ticking, I guess. All right. So very interesting about the QSBS. Other than that, do you have any other general advice how to minimize tax upon exit and what to be thinking about in advance just to make sure you're paying the least amount possible?
Yeah, I would say one of the biggest mistakes founders could make is maybe waiting too long to think about taxes, maybe when planning for an exit. And I would say they should start thinking about that well before the sale. Bring in our team to see like, is there a way we could reduce the tax burden by thinking about, should this be a stock purchase? Should this be an asset sale? Typically, a stock sale might be more tax efficient because it could be tax free. Maybe it could qualify for this capital gains treatment, or in some cases, the QSBS exclusion, like Sam talked about, versus an asset sale, which could be maybe more popular for those smaller deals, but could maybe sometimes lead to higher taxes. And if that's a chosen route, maybe structuring it as an installment sale could help spread those gains over several years. So there's different strategic plans to think about for those tax opportunities. I think another big one is leveraging tax attributes. So net operating losses, maybe any tax credits to help offset any taxable gains. These are pretty common for our tech and e-commerce companies since they're often accumulating losses during their early growth phases. But just making sure that you're advising with your tax advisors and getting like the full picture of how to plan it out.
So just to chime in a little bit. So, right, when you're thinking about what an exit looks like, there's pretty much the way we see it's either an asset sale or a stock sale where the entire company gets acquired. Stock sales are going to be more favorable for a seller. No doubt about it. There's more tax benefits with, I mean, it really just, it flows through. The company doesn't pay tax. It goes through the investors when a stock sale is occurring. An asset sale, a lot of times the buyer may prefer, because you're buying the specific assets of the company. So you're not necessarily assuming all the liabilities that would come with buying the actual stock of the entire company. If you buy the entire stock of a company, you're also buying all the assumed risk and liabilities that come with that company. So yes, an asset sale is probably simpler and more favorable for a buyer just simply because of they're not assuming as much risk. But it's less favorable, I think, as a seller because you're then paying tax at the company level, because if any gain on that sale is reported at the company level. And then once you start distributing all the rest of the earnings and profits back out to the investors, that's also tax. So I would definitely say our advice is pretty much not to do an asset sale unless there are specific reasons or you're selling off a piece of the business if we're talking about a full-blown exit. Now, with that being said, in terms of what you should be thinking about to minimize taxes in the long run, I think something that we're probably completely ignoring is all the potential tax exposures that the company perhaps maybe didn't think about in the course of their business. So we always recommend clients we always call it due diligence ready. Make sure your financials are clean. Make sure you think about sales and use tax. Make sure you're thinking about property tax, payroll tax. Are you paying people as employees and not contractors? Are you thinking about, do you foreign employees or contractors? Are you creating any permanent establishments? These are all things that are going to be asked when you're doing your due diligence, when you're trying to sell or raise capital for that matter. So I always say it's not necessarily about being 100% compliant, which is obviously the recommendation, but it's understanding and knowing what your exposures are. So when you're ready to sell, you can come with a list of explaining why you haven't been compliant in certain areas and what that exposure is, so that it's not material, or what you're doing to rectify it, because that's going to make the diligence process and the selling process a lot easier, a lot cleaner, and a lot smoother.
All right. That makes a lot of sense. In the past, I was on the due diligence tax side. I've been there, done that. So moving on to the proposed tax reform, any thoughts on what that will do, where things will land, and how that will influence brands in general and ecom specifically?
The biggest things right now that we're seeing I could touch upon is Section 174, research and experimentation for our clients with R&D. It's been a big deal for us because you have to capitalize any R&D costs. And they're proposing right now, as the current law stands, you have to capitalize U.S. and foreign R&D costs. They're proposing that down the road, starting in 2025, you'll only have to capitalize those foreign costs and amortize over 15 years. So that could be significant to some of our clients that maybe only have U.S. costs that we've been capitalizing in the past. And for our smaller loss companies, that's been bringing some of them into a taxable income position. So I think this is going to be a big deal for some of those companies. We've been running projections to see what it would look like either way, but we're hoping that those get passed sooner rather than later, because I think that's going to be huge for some of them.
I think the other major thing going on right now, which isn't really part of the tax reform per se, but all the tariffs that have been going into effect, getting paused, going into effect. This is significantly disrupting the e-commerce industry. It's affecting supply chain. It's affecting just costs. It's really having a significant impact. And right now, mostly it's really creating alarm and uncertainty, which isn't ever great when people are looking for investors or just trying to, keep good profit margins. So I definitely would recommend staying on top of that, thinking about where are you purchasing your products from? Are your products coming into the U.S. and going back out of the U.S. to sell? So just really thinking about your supply chain. Could you move it, or how can you rethink, through things? But we've been really following it closely, and we also have a team at Withum that's really just tackling all the tariff issues. So if anyone has any questions, we've been scheduling calls just to go through it and help kind of create planning strategies around that. But it's certainly hard since it's just continuously changing. And is it going to stay or will it not? And really looking at your overall, supply chain and just sort of from start to finish of where your products are. And does it make sense to make changes proactively at this time, or a wait and see approach? So that's something that we've been really monitoring as well, and something that we'll be interested to see sort of where everything lands in the coming year.
Definitely interesting and very hard to plan when things change so frequently, and it just makes things so difficult, especially for ecom brands that are so heavily based on inventory. It's very tough.
Exactly.
Have you seen, has there been any, I know back in the day, about, I don't know, some point in 2024, there was some talk about lowering the corporate tax rate for domestic manufacturing. Has anything happened with that? Is there is that moving anywhere? Do you know?
I haven't heard anything recently, but I was in a meeting yesterday and someone on the manufacturing team actually mentioned that they're pushing for a 15% tax rate on the manufacturing companies, but nothing's been said or pushed through yet. It's in the works.
Right. Interesting. Guess we'll be smarter when we see where this all lands. And not definitely interesting times. Let's put it that way. All right,
Interesting is a word.
yes, yes, yes. All right, thank you so much. This has been a lot of fun. If anyone wants to find out more about Withum, about you, more about this kind of content, where's the best place for them to look?
Yeah, we have a ton of content on our withum.com website. We also have an e-commerce landing page there. You can email Dana and I directly. We also have LinkedIn, so connect with us there. We always post content there as well. But yeah, pretty much we have also a web page that's dedicated to 1202 on our withum.com website. So definitely feel free to reach out to us directly as well. I think Jacob, you'll share our contact information as well after this. So thank you.
Will do. Okay, thank you so much.
Thanks, Jacob.